following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that rocking tune means it is time yet again for everyone's favorite options program, the old Options Bootcamp, the show where we break down raw retail options recruits and rebuild you into seasoned professional options veterans. My name is Mark Longo from the OptionsInsider.com, as well as from a little thing we like to call the Options Insider Radio Network, upon which many of you, I'm sure, are listening to this fine program right now. And joining me on the old Options Bootcamp drill instructor squad, starting off with the man beaming in from back east. You know him, you love him as the Options Majordomo over there at SogoTrade.com. None other than Mr. John Critchley. John, welcome back to the program, sir.
Great to be back. Great show today. Some great knowledge being imparted, and I'm glad to see that Dan made it back from the hinterlands, from his excursion to Neverland or wherever he was. And I'm all excited for the show today.
Yes, it was a fun trip he took out to Neverland Ranch. And if you're wondering who he's talking about, listeners, he's talking about our other drill instructor on the old squad today. He is the options / everything else majordomo over there at Market Taker Mentoring, fresh back from his trip to Neverland Ranch, one Dan Passarelli. Dan, how was the land of the gloved one?
Oh, boy, it was fabulous. It was simply fabulous.
I know that was a childhood dream of yours come true, so I'm sure you were very happy to get out there and take the kids to see that pure, wholesome experience.
Right. I wasn't sure if it was a dream or a nightmare, but it was definitely a dream of some sort.
Indeed, indeed. And now with that lovely, lovely image in all of our listeners' minds, we can keep on rolling right on into our basic training segment.
It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, and welcome to the basic training segment. This is, of course, the portion of the show where we do a lot of what this show is all about, the basic training, the explaining of basic options concepts in some interesting and easily intelligible, easy to understand ways for you, the listener. We've hit on a lot of great topics on this show. If you've missed any of our earlier episodes, I encourage you to check out our archives. You can find them on the OptionsInsider.com. You can also find them over there at SogoTrade.com or in iTunes or Stitcher or Aha Mobile or wherever you get your finer podcasts purveyed to you these days. Check out all of our archived episodes. And so, as we were discussing what to talk about on today's show, We had on a lot of great topics. We started to say, hey, there's a lot of great things here that cover a wide variety of things that they can't really boil down into one essential topic. So what we're going to hit on today instead are, we're going to give you guys some great pro tips from the options market. You can learn a little bit of our wit and wisdom, what we've learned the hard ways over the years, all the many, many mistakes we've made. Let us teach you about them so that you can learn from our mistakes. And of course, the things we've seen go right and the things we've seen go very, very wrong. And just some ways you can utilize your capital more efficiently and trade options more efficiently. So while the other two guys here are kind of stroking their chins and wondering what they're going to use for their pro tips, I will kick things off, give them a couple seconds to mull over and gestate their tips. And one of the tips I like to start off with, and I think that's really, really resonant and relevant for this retail audience here today. Some people come to options for the first time, and their initial trade, probably buying calls, and then they graduate a little bit more, maybe into buying a put to hedge a long stock position. Eventually, a lot of them start turning towards or learning about the values of also selling premium in addition to buying it. Then a lot of them get into the covered call realm. That becomes the go-to trade for a lot of beginning options traders, and also, quite frankly, a lot of financial advisors and other practitioners out there who trade a lot of long equity positions. Covered call is just a great go-to position for a lot of people. And it's a pretty standard position. You know, you buy stock, you write an option. If you've listened to this show, you know you write a very near-term option against that stock because you want to maximize the time decay or the theta that you're collecting from that position. You don't want to write a leap. You want to write a near-term monthly, perhaps even a weekly, depending on your time horizon, type of call. Now, what if we mix that up a little bit? What if we say, okay, we don't want to write a leap, and we want to have stock and generate some income on it, but what if we take what we've learned about time decay and turn that to our advantage yet again? So not just in writing the very near-term option, but also perhaps going a step farther and getting rid of the stock altogether in the covered call trade. And you're going to say, wait a minute, what are you talking about? The covered call has to have stock component. And we are going to have a long component, but we're going to mix it up a little bit. Instead of writing a leap, we can turn around and buy a leap, which is, of course, a long-term equity anticipation security. Those are usually a year or more out. Of course, you don't have to go that far. You can go 6 months. You can go whatever time horizon is comfortable for you, and you buy an in-the-money call or just maybe even a close to at-the-money call, something with a little bit of meat on the bones that could be a good surrogate, a stock replacement, if you will, for the underlying position. And then what you can do with that is turn around and write near-term covered calls against that. So why would you do this? Why would you go to this hassle of buying a long-term call or a deep-in-the-money longer-term call versus just buying the stock and writing calls? Well, there's a couple of reasons. First off, you remember we talked before many times on this show about the Greeks. Our friend Dan here has written myriad books on the Greeks. We encourage you to check them out. But, remember that Greek that a lot of retail focus on is delta. Now, when we're talking about delta, you're buying a stock that has a delta of essentially 100, delta of 1. Wherever the stock moves, that stock's going to move with it, obviously. So it's a one-to-one movement. The stock gains a penny, you make a penny. Stock loses a penny, you lose a penny. You're going to buy an option now, even a close to 100 delta option, that's going to have a delta. It's going to be less than 100, or maybe the equivalent of 100, 99 to 100. The nice thing about that is, what's the major risk in a covered call scenario where, well, of course, the stock drops? Well, as the stock starts to drop, of course, that delta will decrease in that call. So instead of continuing to lose money at a one-to-one rate with a stock, the rate at which you will lose money will actually decline. You will still lose money, but you won't lose it as quickly. So that gives you a little bit of a cushion in the covered call or in the long stock versus long leap or a long deep in the money call type position. That's benefit number one. Benefit number two, this call you buy, depending on what you buy, obviously you don't want to go crazy, but you want to buy something that gives you a good approximation of the underlying without the same level of cost. And so usually if you do that well, if you make the right strike selection, something that's in the money that gives you a good close to approximate 100 delta, yet isn't going to cost the same as buying the stock. Usually your savings could be very large by doing that. You can save anywhere from 30 to 50, maybe even 70 or 80% of the cost of buying the stock position outright. So that's a very large and tangible benefit because now you have an approximate position to the underlying that is costing you roughly anywhere from a third to a half, maybe even two-thirds of a savings of what you would have paid for the stock position. So that's a very, very demonstrable benefit now. So now you have the benefit of the delta decreasing as the underlying drops. You have the benefit of saving a lot of money, which you can then put towards other trades, again, getting towards that theme we've hit on many times in the show of utilizing your trading capital more efficiently. And the last, again, going back to the Greeks, is vega, volatility. Remember, we're talking about stock. Stock doesn't have the options component of volatility that an option does, clearly. So when the stock drops, it's going to drop. When stock rallies, it's going to rally. It's going to move 1-to-1. That's going to be about the same. Whereas an option has this vega component, this sensitivity to volatility. So as the underlying drops, again, the worst case scenario in a covered call position, you're going to have a position that is long vega, long volatility. So as the stock drops, vega generally tends to increase. So in addition to having the delta decrease as the underlying drops, you're also going to have the vega increase, which is going to increase some of that premium, again, offsetting some of the decline in that option. You're still going to lose money, but it's going to lose money at a slower pace as the volatility increases. So those are three very clear and demonstrable benefits of using a long-term call, perhaps an in-the-money nearer-term call, maybe 6 months, maybe farther out, a leap or beyond, depending on what you're comfortable with and, of course, the premium level you want to pay, and taking that and swapping that out for the underlying and then writing near-term calls against it. And then, of course, you've constructed a position that is analogous to some of the time spreads we talked about before on previous shows, just a much longer time horizon. So there you go. That's a great way to maximize your covered call trading and to generate much more bang for your buck and also free up some more capital for other trades, just making a quick and simple little switch to the way you trade your covered calls. All right, that's my pro tip number one. Hey, I went 15 minutes, so I guess I should try to dial my tips back. I don't want to hog all the tips, so I will now toss it over to my black-hatted companion and see what Mr. Passarelli over at Market Taker Mentoring has in store for you, ladies and gentlemen. Take it away, Mr. Black.
Oh, boy, you know what? I have some pretty great tips, and I just kind of want to start out with something that's kind of conceptually important. Maybe not quite as profound and detailed as what my white-hatted counterpart has just indicated.
I am not, if not profound, sir.
But like many of you, in my home, I have one of those newfangled internet machines where I get emails from people. And being as I'm in the options industry and been in it a long time, I get a lot of emails that are options related. Some from good friends like Mark and John here, and some from guys who I don't know how the heck they got my email. They just spam me with this BS. And some of these emails promise these super systems of can't lose trades. Our trade record is 100% wins for the last 27 years, and we make 500% a day. You've seen these emails. Everybody gets them, sadly. You get on these lists, and it's just bad news. I've got to tell you something. I've been trading for a long time. I've been in the options business for 20 years. I stood down on the floor of the CBOE and the Board of Trade for a lot of years as one of the biggest traders in my pit for a time. And you know what? I've had plenty of losing trades. Everybody has losing trades. You're a novice trader, you're an intermediate trader, you're an experienced trader, you're a professional trader. You have losing trades. Being a good trader is not about being clairvoyant. It's not about knowing what's going to happen or anything like that. It's about playing the numbers. Good old-fashioned statistics. And statistics indicate that, hey, sometimes you're going to win, sometimes you're going to lose. But if you're a good trader, you'll probably end up with more winners than losers, although that could be debated as well, depending on your strategy. And your winners are going to be bigger than your losers. And in the end, you can make a whole lot of money being a trader if you're good at it and have your fair share of losers. So, don't get hung up on this, when you see these guys who say they've got this great track record and, they've never had a losing trade. Delete that email, hit unsubscribe, mark them as spam, and move on.
So don't buy into the guru hype. Then that is your pro tip summarized neatly and succinctly. Would you agree?
Yeah, there are plenty of people out there who teach people how to trade options responsibly and teach them how to have longevity in the options business. For example, Market Taker, my company. I don't go out there and say, hey, I'm going to make you rich overnight. I say, I'm going to teach you how to trade options. I'm going to give you the skills so that you can make money in perpetuity. I want to teach you how to trade options. And to be fair, I could give any of our listeners a strategy that makes money 99% of the time. I could. I've got one in mind right now. Makes money 99% of the time. Who wants to hear what that strategy is? Before I tell you, what if I told you that when you do make money, that 99% of the time, you make about a nickel per contract. But that 1%, that one time when you lose money, you lose your house. You know, I mean, I could sell out really, really far out of the money SPX calls or puts with a 1 delta, right? I could do that. That'd make
fortunes
money
have been made that way, sir. It is nothing but a guaranteed way and path to success and glory and riches. You know that. Shame on you, sir. Denigrating such a time-honored tradition.
Yeah, well, you know, I mean, the bottom line, the moral of the story is it's not just about your percentage wins. And in fact, the opposite conversation, we can have that as well. There are plenty of people out there who put on strategies that they know for sure they're going to lose 70, 80, 90% of the time. But they're going to have incredibly small losses. But when the market hits, when things go their way, they're going to hit a huge home run and make a mint. So it's not just about your win-loss ratio. It's a little bit more complex than that, and you've got to think about it a little bit more complexly. And, you know, don't buy into the hype.
Don't buy the hype. That is Mr. Passarelli's quote for the day. That is one, indeed, to grow on. Now, Mr. John, I can hear you champing at the bit in the background here. You want to dive in on this conversation. So, sir, I know you have quite a bit of pro tips stocked up there ready to go. Have at it, sir. Unleash your first pro tip here for our listening friends out there.
My first pro tip is a variation of something that myself and my colleagues have mentioned in the past on the show about using market orders in the option, but there's a slight variation here. The variation is that I say never, ever, ever, never, ever you enter a market order in the option marketplace pre-market. Because what happens, folks, is that there's all these exchanges, 10, 11, 12 exchanges. And when you send an order to Sogo Trade or any broker pre-market, that order has to go to one of these 12 different exchanges. And if it's a market order, it's going to get executed at the price that that exchange deems is appropriate. So you're at the mercy of that exchange. You will not get the MBBO. It can trade way through. We've had customers with big errors, not errors, but big trades that went against them because they went to a certain exchange. Even the big ones, the ICE, the CBOE, you know, sometimes the trade can get executed away from the market. So if you must enter a market order you really want to at the opening, just wait a minute or two. Wait till all the markets are up and running, and then if you enter a market order, you're going to get the MBBO to some degree. They may move a little bit, but you're going to be pretty fairly priced. But if you enter a pre-market, a option market order, you are asking for lots of trouble, and we see it almost every day.
Good tip, something we've hit upon on this show in the past, but always worth repeating, is that those market orders, particularly pre-market open, that's just that's a road to ruin if you dive in on those types of scenarios, which is why if you are going to trade around those time frames, around the open, make sure you have a limit in mind and a preset level in mind, particularly around earnings times, post-earnings, when vol is just imploding or perhaps exploding and things are very much fluid, very much in flux. You don't really know where the levels are. So think about it ahead of time. If you just go in at the market, you're really putting yourself at the mercy of the wolves, and they will run you over as they're looking to do other trades and leg into other trades. So you don't want to be that person who's given them opportunity to use you to leg into something else. So be savvy, be smart, think about your levels ahead of time, and that will be a good way to go. Now, my next tip here, I realized I shall go a little quicker on this one so I don't take up all of John and Dan's time here. And when I was thinking about talking about the last one, I should probably even go back and take that back a step further first, because I mentioned, of course, swapping leaps in for covered calls, but I don't want you to think that that's something that is limited to just writing income type strategies. This is the type of trade that I think a lot of our listeners who are these buy and hold equity guys, and hopefully if you've been listening to us for a while, you've kind of seen the value, or shall we say perhaps the lack of value, really in true long-term buy and hold. You need to be more active than that. But that aside for a second, if you are one of our many listeners who are equity buyers and sometimes buy and holders, that can get expensive. You know that you buy stocks, you can buy them, it costs you you a lot of money to buy them. Best case, you get 50% margin to buy that stock. Either way, it's an expensive proposition. I mentioned using the leaps before as a way to generate income, but you don't need to use it just in that context. You can take it back and use it as what is this known as a stock replacement strategy. And we've hit on this a long time ago on the show, but I think it's worth really repeating here, particularly for some of our newer listeners. And I know looking over there at iTunes, a lot of new people coming in all the time. That this is the strategy if, let's say, you're long XYZ stock's trading at 50. Of course, 100 shares is going to cost you a clean $5,000, $2,500 if you buy it on margin. But that's not the only way to go. There are options out there. Usually we're talking about stock replacement. We're talking about options that are at or near the 100 delta of the spectrum, maybe in the 80, 85, or 90 range, somewhere along that end of the spectrum. So higher deltas, so they are more of a stock equivalent. And you can do that in a number of different ways. You can do that in some nearer term. By nearer term, I don't mean front month. I don't mean weekly, for heaven's sakes, unless you really have a very specific time horizon. I'm talking more maybe 3 to 6 month range. You can buy an in-the-money option in that range that will give you some approximation of the underlying without really all of the outlay. And you can look at that and schedule it accordingly. Maybe in that hypothetical scenario I just outlined where instead of spending $5,000, maybe you can buy a call for $10 and now you have a $1,000 trade as opposed to a $5,000 or even a $2,500 trade. So you can see the clear savings by doing that. And these positions, if you execute them correctly, you get a stock that has enough of a delta and has enough of a time horizon so you get some time for this trade to work out in your favor. It can really be a preferable scenario to just buying stock outright all the time. That can be very expensive, and that's a very limited strategy. Once you have that stock, it's kind of limited. Whereas with options, you can do a lot more with that, and you can put your capital to work much more efficiently. So there you go, another way to just utilize that stock replacement type strategy is even simpler. You don't even need the income component. You can just use the leap or use the nearer term 3 to 6 month range, perhaps maybe up to a year, in the money call as a way to structure some sort of stock surrogate or stock replacement position. Put your trading capital to work more effectively. All right, Mr. Black Hat, tossing it over to you. What's next on your list of pro tips for our listeners, sir?
Well, here's something we've kind of talked a little bit about in the past as well, but it's another one of those that's worth repeating, and maybe I can flesh it out a little bit here. So, concept. Options are not simply proxies for the underlying stock. A lot of people get attracted to options initially because somebody says, well, why are you buying the stock? You can buy the option and have similar exposure and pay a whole lot less. So you have protection and leverage kind of combined in one instrument. You think, holy cow,
that sounds familiar. I think it sounds like I just heard something like that. I don't know who would have said such a crazy thing.
I don't know. Could have been someone on this radio show besides me. But
I'm looking at you, John. I know it was you.
But to kind of just follow up with that, to follow up with what we've been talking about here, there are other components besides the directional component of options. There is a time component and a volatility component. So you're trading all three of these things with every single option trade you make. You're always trading. You always have a directional component, even if the trade starts out delta neutral or delta indifferent. Gamma will give you a delta if the underlying stock moves. So there's always a directional component to your trades. There's always a time component to your trades. And there's always a volatility component to your trades. So even if you do something as simple as just simply buy a call, you're basically trading three things. So if you were to go out and buy three stocks, forget about options for a second. You were to go out and buy three stocks, would you just spend all your analysis thinking about one of those stocks and just haphazardly buy the other two and just kind of hope it works out? No. You would spend your analysis equally on all three stocks because you're trading all of them. Well, that's how it should work for option traders. You're always trading direction, you're always trading time, you're always trading volatility. So on every single option trade, you should analyze those three things. You should always try and make money on all three of those things. You should always put every advantage to your favor that you can. And the biggest thing to do is to look at implied volatility on every single trade. Because whether you know it or not, and my goodness, I talk to a lot of novice traders, and half of them don't even know that they're trading implied volatility. Implied volatility, they don't know what it is. but they're making and losing money on it on every single trade. So do yourself a favor, make money in a place where maybe you never thought to make money before, on implied volatility. So there's my pro tip for now. Maybe there'll be more. I don't know.
And of course, if you are using Sogo Trade, a lot of great ways to find your Greeks and find your implied vols over there on that platform, so you can do exactly what Dan described. So when you're first starting off, you can, of course, use those stock surrogates, stock replacements when you're more delta directionally focused, as we've discussed on the show many times. But as you listen to the show over time, you become a little bit more sophisticated, a little bit more nuanced. You can graduate to some of the more volatility-centric and just a general stronger understanding of volatility and how it impacts your trading. And then, of course, you can graduate some of the other types of strategies we've outlined on this show in the past, like calendars and other things like that. All right, Mr. John, I can hear you just clawing at your microphone saying, let me in, I want to talk too. So, Mr. John, what's next on your endless list of tips for our listeners?
Yeah, I just want to touch on Dan's topic, which is a very, very important topic. So, staying on the implied volatility topic, I tell customers this is a great tip. Don't base a sale or a purchase of an option based purely on the implied volatility levels without understanding the context of why the IV might be low or might be high. You know, when IV is high, it's not always a good sale. And when IV is very low, it's not always a good buy. There's a context here. Trying to understand why it may be high and why it might be low. Yeah, I said this in the past, but back in the crisis in 2008, the VIX options, or the implied volatility of the S&P 500, was around 80%. But they did a study afterwards saying that if you had actually bought options at that very elevated 80% and you hedged them, the traders or the people that did that made money, because guess what? The underlying or the market was moving at a greater rate than the implied volatility was implying. So just be careful when you see, implied volatility spike. Well, that must be a sale. Or if you see it very depressed, let me sell it. Not always the case, and just be very, very careful there.
And since that was a quick one, I'll let you do another one there, John, so you can keep hitting down your list here.
Sure. I have another one I mentioned that is really important, is that when you're looking at implied volatility, be very careful around expiration. And I know we mentioned this past also, but I get a lot of calls saying on Thursday or Friday expiration, say, look at these options, out of money options. Look what a high volatility they are. So be careful during expiration weeks, or to look at the implied volatility with more of a jaundiced eye, and maybe even take it out and look more at the premium over parity, which is more important. Now, if you're going to go out 1 or 2 or 3 months, Dan's are 100% right. Look at that implied volatility. That's a key component. But during expiration week, this is a big tip. Look more at the premium over parity. That's a better gauge of what you're going to be paying, or what you can make or lose, than the implied volatility number. For example, today I'm looking at the option chains in Apple and Google and Netflix, and if you look at the out-of-the-money options by like 1 or 2%, the implied volatility numbers are crazy high. But they're not at sale because they're only nickel or dime options. So just be careful solely basing your decisions on IV during expiration week.
And of course, when he talks about premium over parity, he's of course referring to the extrinsic value of the option. If you're confused about extrinsic and intrinsic values, again, I encourage you to go back, listen to our earlier archived episodes of this program, or search for those terms on our site, or head on over to Sogo Trade, or check out Market Taker Mentoring and call up Dan. He'll answer your questions personally, even 1, 2 in the morning on his cell phone.
Especially then. He's really, really open for business for you listeners. All right, continuing with our tip bonanza, our tip palooza, to tip our hats to Lollapalooza, the local concert that just wrapped up here. Our next tip is one, a lot of our listeners, particularly, or a lot of our readers, I should say, really, coming on over to theoptionsinsider.com, they see we do a lot of unusual activity alerts on the site. And whenever we do those, I want to just throw out to our newcomers to the site and to this show some interesting ways that they should really be using unusual activity. The typical unusual type trade that we'll profile, because this is about 80 to 90% of the trades that go up, are someone comes in, they think XYZ stock is going to pop, and they buy 1,000, 5,000, whatever, 10,000, 10%, 20% out of the money calls, hoping to profit on a pop in that stock. Now, people will read that on our site, and they'll say, wow, this stock's going to run. I'm going to do what that guy did. I'm going to buy those same calls.
Not realizing that what that types of trades do, the reason they're unusual for a reason, is because they're outside the normal trading spectrum of that underlying and of those options. As a result, those trades are distortive. So if someone comes in and buys, let's say 5,000 or 10,000 out of the money calls on a particular underlying, it's going to distort what we've just talking about here on the show, what we said many times in the show on the past, the implied volatility levels on that strike. When they're buying that many options, things don't just stay static. Things adjust in the options market. If someone's buying that many contracts, it's going to inflate the overall level of implied volatility. So now a trade that already was lower on the probability scale in terms of payoff probability because it's an out-of-the-money call, the delta is substantially less than 50. Now you have someone bidding up that vol. You're coming in after that person. If you're going to follow on that type of trade, you're going to pay even higher levels of volatility, even more inflated premium levels. Again, going back to what John was saying about premium over parity, you're going to pay much more than that initial person who got in on that trade. So you're following a low probability trade with an even lower probability trade. So what we like to say all the time when people read our unusual activity and they're trying to wrap their heads around how to interpret it is that don't be a lemming. Don't just blindly follow these types of trades that we're outlining. First off, of course, do all your homework in the underlying. Make sure you agree or disagree with the sentiment being expressed in that particular trade. But then look at it from a more nuanced perspective. Look at it in the many ways we've taught you on this show. And that is to look at the different levels of implied volatility and take advantage of the distortions that these unusual activity type trades create in the marketplace. For example, this person buying a lot of 10% out of the money calls. He's bid up the volatility on those upside strikes, on that implied volatility skew north of the at-the-money strike, which is, of course, known as the call wing of the options. Now you can look at that and say, I want to follow that trade. But if you jump in behind that person and just blindly follow him, now you have a trade that is, like we said, lower probability even than the initial trade, which is very low to begin with. But now you've listened to this show, you realize more about implied volatility and the Greeks and delta, all those things, and you realize, wait a minute, I can increase my probability trade in that particular scenario by, let's say, buying an at-the-money call instead. Now that's going to be more expensive, but I can take advantage of the distortion created by this person coming in and bidding up all these out-of-money calls and then again legging into a spread and selling the strike that this person has just bought. So now you're still putting on a bullish, in fact, a more bullish trade. You're moving it closer to the at-the-money, therefore increasing your probability of that trade actually paying off and working in your favor. A much higher probability trade than the typical just following in and buying the out-of-the-money calls. And you're also taking advantage of that distortion that trader has created and being able to buy that spread for a much better price than you would have if you just bought the at-the-money call outright or if you just bought the out-of-the-money call outright. So that's what we're talking about when we're saying be nuanced, be sophisticated, take the lessons we've taught you on this show. So when you come over to sites like ours or other sites that highlight unusual activity and you see the flurry of out-of-the-money calls trading, don't just be a lemming and dive right in. Take a moment, take a breath, think about what we taught you on this show, and think about the ways that you could take advantage of that distortion that's been created in the options and not just blindly follow that person from a directional perspective. There are usually many much more nuanced, much more sophisticated, and usually much more effective ways to follow that type of trade without just blindly leaping in after them. So that's my pro tip for you on unusual activity. And now I will toss it back down the street and over the river and way the heck down to the south to scenic, lovely Frankfort, Illinois for our friend Mr. Passarelli.
Thank you. You know, I've got a really great tip. Fit the strategy to the situation. There are a gazillion different option strategies. You know, I'm kind of rounding to the nearest gazillion, but I think there's 1 gazillion different types of option strategies available to the trader. All these strategies exist for a reason. There's not just one best one, you know, and that's another one that I see in some of these spam emails. Oh, you know, this is the best way to make money if you just know this one strategy. Well, guess what? There's a saying in the options business that it works until it doesn't work. No strategy works all the time. That's why all these crazy option strategists dreamt up all these other strategies, because different market scenarios require varied option strategies. For example, when a trader expects volatility to increase, you're not going to go out there and trade an iron condor or a credit spread or a time spread. All those are great strategies, and boy, they make up a pretty big percentage of the types of trades that I do. But if I think that volatility is going to increase, I certainly wouldn't trade those. I would trade something more like a straddle. If I'm looking for an income trade, I think a stock is going to stay in a range. I could jump in and I can trade an iron condor that's just 2 credit spreads paired up. But I would also look at the term structure volatility, see if maybe a better, smarter way to trade it is with a time spread. Trading options is kind of like playing chess. You really have to sit and kind of think a few moves ahead and really kind of strategize in order to craft the sort of position that you want to trade. You always want to put on the best position for you. You need to be exploitive, opportunist, and find ways to have the highest probability you can get, to lose the least amount of money you can if the trade goes against you, and make the most amount of money you can when it goes your way. So use all those tools available to you and structure your positions. Basically let the market tell you which of the many strategies you have to choose from, which of those to put on.
Yeah, that's a common problem with a lot of the new retail traders coming to options. They fall in love with whatever strategy. A lot of times it's the iron condor. That just seems to be the sexy thing over the past couple of years. There's a lot of newsletters and sites out there promoting the iron condor and how it's a no-lose type of scenario and very risk-mitigated trade. All of those things are certainly true, but, one strategy is never good for all seasons. And so there are, as we've hit on this show many times, there are many different option strategies. I think Dan's technical term was a gazillion, and you should certainly be fluent with more than just one. So when you look at a particular underlying, you can choose the strategy that is right for the position and right for that time frame, and not just say, well, I have to ride an iron condor now, or I have to buy an iron condor. How can I force this to work in this particular scenario? Because that's usually a recipe for disaster. All right. Mr. John, bring us home. You can do one, maybe even two. I'll be generous. I'll let you close us off with two if you really want to. So take our listeners home, sir, with some practical and insightful pro tips.
Sure. I'm going to leapfrog back to Mark's great tip about the unusual activity. When I look at reverse skew all the time, and what reverse skew means is that basically the out-of-the-money calls, about 95% of the time, are going to have a lower volatility than the at-the-money options, and certainly the out-of-the-money puts. When this skew flips, it's usually, to me, a big buy signal or a big, a go signal that something's afoot in the underlying. So in that sense, unusual activity, what Mark was saying, is a great way to, if you have an unusual activity screener, to look at that, because when a reverse skew flips and the at-the-money calls become higher than the at-the-monies, you can put a call vertical on, like Mark said, or you can maybe even be a lemming and buy the calls. But it's a great indicator of an upside event, or somebody thinks an upside event. It's very important that the big trades are not always what they seem to be. Again, going back to Mark, I mean, we touched on this in the past on the other podcast about synthetics. If a customer comes in and does this 5,000 or 10,000 time trade, and let's say it's at the money trade, they do. Well, you don't know what that institution, that fund, I'm guessing, has on. They may be hedging that with stock. And then guess what, folks? That call that they bought is now a synthetic put. So be careful a little bit with that, with the unusual activity. Normally with the out-of-money calls, like Mark was saying, funds usually aren't buying a lot of out-of-money calls and hedging them because the delta's low. And that's a little bit in the weeds type of analysis. But again, look at unusual activity, look at reverse skew, and if you see it flipping, it's usually a big buy signal. One more quick thing. These options I'm talking about, the out-of-the-money options, normally my guidepost is about 25 cents or higher. If you have a nickel or dime option and all of a sudden someone starts buying them at 10 or 15 cents and the implied volatility goes up, sometimes you can throw it out the window for the analysis. So I use about a quarter or higher. If the option's quarter higher and it's out of the money, then I think it has some meat where the analysis usually holds true and steady.
All right. Thank you for that, John. And, of course, Dan, those are some useful pro tips, I think, that will help you improve your day-to-day options trading. And now we're going to keep on rolling right on into my favorite part of the show, and I'm sure a lot of our listeners as well, because it's your segment. This is, of course, the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, here we go once again into the mail call segment. As the name implies, this is the portion of the show where you, the listener, get your chance to sound off and chime in and make your voices heard here on the Old Options Bootcamp program. And the first question comes in from Mr. Ron Yurovich, and he writes, I listened to the podcast on calendar spreads and would like to know what book do you recommend that is comprehensive on spread trading. I have never had much luck with spreads. I have done a few iron condors for credit and a few credit spreads. I just let them expire. The concept of trading the spread and not the underlying is new to me. I see that I still have a lot to learn, but I am determined to be a well-seasoned, successful options trader in the end. Keep up the good work. I respect your group for your knowledge on options. Well, thank you, Ron, for your kind words. And I'm glad to hear that you're starting to experiment with spreads. I'm sorry your early forays didn't go perhaps as well as you hoped, but you're right. It does take a little bit of time, and it does take a little bit of a changing of your mindset. You know, as you said earlier, even on this show, so many people come into options so directionally focused, so focused on options in correlation or perhaps as a surrogate to the underlying. Then we start getting into spreads, in particular the calendar spreads we were talking about on the recent 2 episodes, where the spread is the main focus now and not particularly the underlying. That's a bit of an intuitive leap for a lot of people to make. So you're right. It does take a little bit of thought process, a little bit of retooling of how you think to look at the spread as its own beast before you look at some of the other analytics you may be used to looking at. So yeah, I think you're heading on the right path. You mentioned iron condors. Everyone seems to start off with iron condors. They're just a sexy trade these days for whatever reason. But in terms of books that are comprehensive on spread trading, now, Dan, I know you hit on spread trading in your books, but your books are not about nothing but spread trading. So what's your take on this question for Mr. Ron here?
Yeah, I mean, well, my books are, they definitely mention spreads, but I mean, the concept of the books, I mean, the one is trading option Greeks. So it's Greeks kind of across the board from just simply one-legged options all the way to spreads. And then, of course, my other book, The Market Taker's Edge, is kind of how to get edge on trades, and that sort of encompasses a lot of the things we talked about, I guess, during this show.
When your clients come to you, Dan, and say, hey, what's a good book for spread trading, where do you usually point them?
You know, to tell you the truth, I've actually written more books than I've read on options. I don't know, I guess I'm embarrassed to admit, but I got my options education from the black and the blue, fighting it out down in the pits as opposed to reading about it.
That's actually, that's funny, but there actually is some truth to that. I kind of fall into the similar camp where, I've read, the books when you first start off, and of course the books that they give you when you first walked on the trading floor here in the SIBO. Everyone was pretty much handed a copy of good old Natenberg's Options, Volatility, and Pricing, and that was pretty much the Bible, and everything else you kind of learned by doing. So in the concept of a book that I would recommend purely on spread trading, I haven't looked at too many recently that are, I say, A, purely about spread trading, and B, that I would recommend. So I'll have to go dig through perhaps the literature a little bit more. But in the meantime, there are a myriad of outlets you can go to find this stuff on your own and for free or very low cost. Of course, your broker, whoever your broker is, I'm hoping you use Sogo, but you could use any broker that you see fit, and they will, of course, the better ones anyway, will have a lot of great education. Of course, guys like Sogo will go the extra mile, also have shows like this that will help reach out to you listeners and help educate their clients as well. But whatever your broker is, if they're an option-centric broker, they should have a great educational section. You could click on that tab, and that should walk you through the basics of spreads. They should probably have some spread screeners in there that you could use, and that would help you, even if they have a paper trading function. I think one of the better ways, perhaps maybe than just reading a book, is putting on a theoretical spread that you may want to do, a calendar in, let's say, Facebook. Everyone loves Facebook these days. And let's say you just do a simple one month straight up horizontal calendar spread, and you put that on in their paper trading app, and then if it's a good brokerage firm, and a lot of them do offer this, you can adjust those underlyings a little bit and see how that trade performs. And you can adjust the Greeks a little bit and see how that trade performs. And that I would recommend before I would say go out and read XYZ books, because that gives you much more of an intuitive and realistic sense of how these trades will perform in a variety of scenarios. And that's really the best way to learn. I mean, I've said this many times. One of the main reasons I lament the kind of death of the market-making path and the market-making career is, that's the way that guys like John and Dan and myself got into this business, and that really still is orders of magnitude beyond any other way that you could possibly learn options, because you're really thrust into the fire and you have positions thrown at you all day long that you never anticipated and never wanted, and you have to deal with them from a risk management perspective. And what better way to learn how to manage risk and how positions perform than by literally being thrown into the fire like that. Most retail these days cannot replicate that. So in lieu of that, I think going into some of these paper trading functions before you put your real money at work, or at risk, I should say, and starting to play around with the different variables that they give you. When we were on the floor, that's what we would do. We would put down our positions, and we would get runs up and down 5 and 10% in the underlying, up and down 5 or 10% in the volatility, and see how that affected the overall position. You should be doing the same thing. And once you get a handle, like I said, focus on the basics first. Focus on the simple 1 month horizontal spread. And if you can start getting a handle on how that performs, remember we said going long that spread is typically a very underlying neutral type of strategy. You don't want the underlying to move very far. Start playing with the underlying a little bit and see how that performs. And now you say, okay, I get that. I get how that long 1 month horizontal time spread is pretty much a very basic neutral type trade. Now let me see how that changes up if I maybe go diagonal instead, and now I buy an out of the money call and then sell the at the money in the front month and see how that works. And you start playing around with these variables, start playing around with your strike selection, start playing around with different ratios perhaps, and that will start giving you a better overall intuitive sense than perhaps any book that I could really point you at, Ron. And of course, Ron, keep listening to shows like this. Surf on the websites like the Options Insider, or head on over to Sogo Trade in their educational section, or call up a guy like Dan, and they'll walk you through it. Again, I encourage you, all listeners, 2 in the morning, his cell phone number will be posted in the show notes of this episode. He loves those calls, 2 in the morning. His wife also very appreciative of those calls. All right, great question, Ron. Next up, we have a question from Mr. Tom Simmons. Looks like this one is square for you, John. So Tom writes, just to clarify, and this is, if you're not sure what he's talking about here, listeners, Tom is referring to what we discussed with calendar spreads from the most recent 2 episodes and the margining of those spreads. And Tom writes, just to clarify, if I write a time iron butterfly and he gives us a specific example here, in Dendrion, which is DNDN, ahead of earnings with Sogo, if I sell the September 5 straddle by the August 4-6 strangle, Sogo will margin me as if I sold the Sep 5 straddle naked, because the August will expire before the Sep. Do I have that correct? Just to walk our listeners through a little bit what he's talking about here. Dendrion is a stock that just had earnings actually yesterday, I believe, so hopefully our friend, if he did this trade, did it before earnings, or perhaps not. Looks like Dendrion moved quite a bit, down about $1.10, trading at $3.50 right now, so it's off about $1, so maybe he didn't do this strategy, or maybe it didn't work out for him. But he was talking about selling doing a typical iron fly that we talked about on the show before. You sell a straddle or buy a straddle, and you sell or buy a strangle against it. So it's kind of like an iron condor, but tighter and closer to the at the money. But doing it on a time basis, so you sell the guts, the center of the spread, in the 1 month out contract, and then buying the nearer term strangle to protect it. In this case, he's looking to collect a lot of premium, but also to protect himself, I'm assuming, through the earnings event that just happened last night. The AUG will certainly give him that. So, John, walk our friend here through the margin requirements and let him know if he has it correct.
Yes, he's 100% correct. From the mechanics from a retail broker's perspective are just too complicated, too time-consuming to monitor. So if he does that spread that he mentioned, we have no way of making sure that it's just too complicated to put in place the risk parameters. So again, he's gonna have the short side is gonna be fully margined, and that's just reality of the retail brokerage business. As traders, we didn't have that. We had the portfolio margining, so we had up or down 10%, and volatility up or down 20%. But in this case, there's nothing that we can do that if you don't have portfolio margining. I mean, we do everything we can to try to accommodate a customer, but we just can't monitor this, because basically what would happen was we would have to shift this customer's account 1 day forward, and by like 10 to 4 on Friday of expiration, we would have to make sure that he covered the short position, the short resulting position, if he didn't have enough money. It's just too complicated. I mean, I know for Sogo, for example, because I handle the expiration, we allow customers to have positions expiring up until about maybe 5 to 4, 10 to 4. And also, if we see this customer is alive and active in the marketplace, sometimes we don't even take action. I know other brokers at 3 o'clock, they'll close them down. So we're very flexible with our customers. But in a case like this, our hands are really tied, just in a regulatory sense and in a risk management sense.
Yeah, and just to follow up on what you were saying there, John, I talk to a lot of novice traders who say, oh, these margin rules, they're so restrictive and that kind of thing, and they complain about margin rules sometimes. But case in point, I mean, frankly, this listener who's writing this in, let me just be kind of straightforward here with you. It's my floor trader coming out in me. You would never want to do an iron butterfly like this on a stock like Dendrion going into earnings. I mean, you would just never want to do that. You should thank your broker for basically trying to help dissuade you from making a trade that's really, really not something you want to be getting involved in. That's kind of my 2 cents. It's tough love, baby.
Why do you poo-poo this trade so much, sir?
Well, I mean, I guess hindsight's 20/20, but that's not really the real answer. I mean, when you put on a trade like this, you get what? Negative gamma, right? Negative gamma means movement is bad. I lose money if the stock moves a lot. What is the single biggest day that one would expect movement to occur? Earnings. So basically, you're putting on a trade that says, if the stock moves, I lose money, and I'm going to do it a couple days before I know the stock is going to move. Doesn't make sense.
I love it. A lot of our premium sellers in our audience are now just screaming in pain and saying, no, Dan, no. Stop saying that to
I
me.
love selling premium. Most of my trades are premium selling trades. And don't get me wrong, every once in a while I'll put one on before earnings if the volatility is set up is such, that it warrants it. But I mean, for goodness sakes, if you're putting on a strategy that says, I think the stock is not going to move a couple days before you're pretty sure the stock is going to move, you're kind of doing something philosophically dreadfully wrong.
Particularly in a name like Dendrion, of course, that is a biotech. These things can go all over the place, as we are seeing today with the stock down about 25%. So an aggressively moving name. Hopefully it's worked out for you, Tom, if you did it or if you didn't. But yes, to moral of the story, long answer to your question, yes, you have it right from a margin perspective. That is exactly how it works, and it's not unique to Sogo. All the different brokerage firms out there do the same thing. All right, and last up, we have a question from Mr. Alan Dickerson out of Provo, Utah, and he writes, options are a derivative of stocks, yet there are far more options exchanges than stock exchanges in the U.S. How is that possible? Why are there so many options exchanges? Do they all trade different products or serve different purposes? Well, great question, Alan. I'll have to do the math on exactly. I know how many options exchanges there are, how many equity exchanges there are across all the different various and facets, and see exactly if there are more options exchanges. I have a feeling it's a little bit closer than you think. But in general, the nugget of that question is, why are there so many options exchanges? And that's a question that I think a lot of us are still, even on this show, are trying to wrap our heads around. It's a question I always ask whenever I go to the Options Industry Conference, which I just went to a few months ago, and there's announcements of new exchanges and on the horizon, and I talk to the CEOs of all these different exchanges for some of our various shows we do on this network, and I'll ask them, why? Why are you doing this? What are you bringing to the table that's new? I had this very question with the CEO of the ISE, who was announcing the launch of a second exchange for his own company. I've said this to the NASDAQ people who now have 3 options exchanges under their umbrella. Why in God's name are you doing this? And, I think for a lot of our listeners, they might think the answer would be, well, it's this, they're looking to add some new facet to the business or draw in some new customer base or offer some new innovation to the table that will be very additive in the long run. Unfortunately, that's usually never the case. In the case of NASDAQ, their very recent new exchange they created was essentially a direct analog of a previous exchange. They just had a regulatory slot in their license that they had empty, and they thought, if they don't fill this, those are very hard to get, they may as well fill it and try it. Same thing with their NASDAQ options market. They launched that essentially because it was a very low initial startup costs. They already had a lot of this exchange functionality built from their equity side. They can just reportion it for options. So it's a very low cost for them to run and to operate that. So it didn't really hurt them that much to do it. So they thought, why not? In the sense of ISE's new exchange and the CBOE's other exchanges and all the other exchanges we're seeing launch now, really, it's usually a case of pricing models. Like in the case of the ISE, they were much more of a traditional exchange. A lot of the action was in the hybrid maker-taker and taker-maker models, which I won't get into those. That's very, very, very deep inside baseball. But ISE didn't really have much skin in those other pricing models, so they created a new exchange to give them a little bit of wiggle room, shall we say, in those new pricing models. And other exchanges have done similar things. The CBOE launched C2 for that direct reason, to give them some skin in the maker-taker pricing model and allow them more nuance and flexibility in their pricing structure. So when you see all these exchanges out there, usually they're not really two different exchanges. They're owned by the same entity, and one really is. And to answer your question, they all usually trade the same things. There's a few exchanges that have big proprietary products, CBOE being one of them, SPX and VIX coming to mind, really, I think, for most people. A few other exchanges have some other interesting proprietary products, but basically they all trade the same stuff. So the only way they really differentiate themselves is through technology and through pricing. And so you have these new exchanges launching new subsidiaries and affiliates, really just to give them new ways to price options. It's very much inside baseball. It doesn't really help you, the listener. In fact, I think you can make a strong argument that it hurts you, the listener, because anything you're trying to do that's across exchanges, spreads, multi-leg spreads, etc., usually gets gummed up by all these multiple myriad exchanges launching all over the place and having to match away orders and things like that. It makes it harder, not easier, for you guys to get your trades filled. So I'm not a huge fan. And I'm guessing that John and Dan are probably not as well. John, we'll start with you. What's your take here from Mr. Dickerson?
I'm not a huge fan either. I'm a believer. I guess I'm old school, that I prefer the old days of 4 or 5 exchanges, the CBOE, Amex, Philly, and the P-Coast. I just think, and then the ICE came in. I just think that the more fragmented you get, and you're right on the mark there, that no pun intended, that when you try to do a spread, you have all these different exchanges, the markets. You think you're going to be filled, but you're not, because it's bid here and it's offered here. It's just a big mess, and it's a huge problem with, as we mentioned earlier in the show, with these pre-market option orders. Then we have a huge problem. So I guess it's a case where they're profitable, and as Mark said, they have the infrastructure in place. So why not? But I don't think it's really that great for the retail customer.
Dan, you're up next. What's your take?
Yeah, I mean, for goodness sakes, we could talk about this for days on end. I mean, I was just kind of sitting here while you guys were talking, thinking of all the things I could talk about here, and holy cow, I could easily write a book on it. But I'm definitely against there being so many exchanges. I think it's kind of silly. It kind of goes against the very philosophy of why exchanges were created to begin with, to have a central location, whether that location is physical or virtual, a central location where trading takes place. So everybody knows what's going on. There's ease of transferability. You don't have some of these issues that John was just talking about, and I think Mark actually mentioned as well, of, spreads and, not being able to get filled because one leg's on one exchange, one's on the other exchange, and all that business. It's sort of ironic, and it's continuously ironic, where the same government bodies who are approving more and more exchanges are out there saying, well, we've got to not have so many dark pools and so many over-the-counter things. They should be being traded on exchanges. I mean, they're trying to centralize some of these things while they're fragmenting the market in general. So I think it probably ends up at some point being a disservice to the end customer. One other completely different thought that I could have on this is just from the very core of the question, why are there so many compared to stocks, stock exchanges? Option growth has been, now, I don't know, in 2012, that may have changed. I kind of forget the statistics, but for about a good solid decade, options volume growth far exceeded stock volumes. So options are becoming more and more popular. Investors are getting more and more sophisticated. They're learning that they can protect themselves by using options, and they're doing that. So I think the popularity of options is sort of one small catalyst. I mean, I think that's just sort of at the heart of it. All the things that Mark talked about competition and different offerings and all that kind of stuff plays in there as well.
Good point there, Dan. Of course, options were the rising tide that lifted all boats for a long time. Options volume continued to show double-digit increases year after year until about a year ago when they started hitting a little bit of a rough patch. So that's why another reason why so many exchanges jumped into it. They thought, hey, stocks are kind of stagnant. Options are growing like crazy. Let's have some skin in that game too. So they launched an option exchange, or they acquired one. I'm looking here at the SEC list of exchanges while we were talking to see if I could get a good count for all the different stock exchanges in the U.S. And of course, my account was completely thrown off because who can forget the Arizona Stock Exchange? I do all my paper down there. What about you there, Dan? This actually is good reading, this list of exchanges on the SEC site. It opens my eyes to some of these others, shall we say, lesser-known sources of liquidity out there. Interesting stuff. Great question there, Mr. Alan Dickerson here. I know we can probably go on that question for a long time, but unfortunately, that's all the time we have for the mail call segment and all the time we have for this episode of Options Bootcamp. But before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Mr. P, Mr. Passarelli, what's cooking over there in the land of market taker mentoring?
Oh, boy. Well, let me tell you. Remember in past shows, rather recently past shows, I was threatening for a long time to launch a brand new product, but I couldn't tell you what it was, and then I did with the futures options. Well, guess what? I'm doing it again. I've got something cooking. Can't tell you what it is. It's going to be about 6 weeks off, but you're going to like it. That's one thing I can tell you for sure. In the interim, let's see. We just finished accepting applications for one-on-one coaching students. There's just a couple of us who do the one-on-one coaching, and so the nature of one-on-one means it's not scalable. We have to put in our time to work with students individually. We can only take so many students at a time. Literally, there's only so many hours in a day. So we actually, as of last year, designed the application process, and we had about 8 spots to fill and got about 70 applications. So haven't quite finished contacting everyone and seeing the qualified candidates yet, but we're about there. So if you're interested in one-on-one coaching, you better contact me pretty quick because we're going to be filled up really, really soon.
Glad to hear it's going well. And you just hinted at it. I know that the new show is really going to be, or the new endeavor is going to be cooking with Dan Passarelli, right? You mentioned it. I think there's a subtle Freudian slip on your part. Cooking and trading options at the same time, too. That's something no one's ever done. So there you go. You're breaking new ground there, sir. I take my hat off to you. All right. And last but certainly not least, Mr. John, what is cooking, literally or figuratively, in the land of Sogo? How goes your great margin endeavor?
Almost there. We just rolled out a new data subscription package. Most brokers require minimum amount of activity or funds to get these much valued composite quotes. We now allow inactive customers to receive these composite quotes for a nominal fee, basically what we get charged. And if a customer does one option trade a month, a whopping one trade a month, they get all the quotes for free. So, we were getting hammered by these rising exchange fees and other, regulatory fees. And in order to keep our costs low, we had this new package because we were getting tens of thousands of customers that weren't having any activity, and we were paying for them. So it's kind of a way where customers who aren't active for $1.25 a month can get the composite option quotes, and for $3 they can get the equity quotes. And if you do one option trade a month, you get them for free. So there's been some confusion out there with some of our customers, and we're trying to clear it up. And but it's a pretty good. I think it's a pretty good plan for any of our customers who trade even at all.
And just really, really quickly, run down what you mean by composite quotes to some of our listeners who aren't familiar with that.
Well, for the equities, the composites would be all the national exchanges. The non-composite would be BATS and some marketplace quotes. For the equity quotes, they're actually excellent quotes. BATS and the other non-major markets give excellent quotes. The volume might be a little bit off, but the quotes are really in line. For the option quotes, we do not. If you get non-composite quotes, you're getting BATS and other non-primary exchanges quotes, you're not getting the NBBO. So the quotes could be a little bit off. But again, for the major products, they're going to be pretty close. But for the illiquid options, sometimes the BATS quotes are a little bit off. But again, for a nominal fee, or if you do one trade a month, you're going to get them for free here.
All right, good to know. Keep that in mind, listeners, when you're trading over there at Sogo. One trade a month gets you all those quotes for free. And of course, if you missed any episodes of this or any other program on the Old Options Insider Radio Network, we encourage you to surf on over to the mothership, theoptionsinsider.com. You can find all of the archived episodes of this and every other program on our fine network. Of course, you can join your fellow listeners and send off your questions for our mail call segment. You can do that posting in the comments on our website, or you can find us on Twitter, twitter.com/options, facebook.com/theoptionsinsider, or do us the old-fashioned way by shooting us an email, questions@theoptionsinsider.com. Just be sure to put Options Bootcamp in the subject line so we know which show you're referring to. And on behalf of Dan and John, and of course myself, I want to thank all of you out there for downloading and streaming and subscribing, and of course for writing in. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.